Welcome to TheoTrade. This is Don Kaufman. It's June 29th, 2016. We start this evening with volatility. This is what it's all about. You know, one of the things I was discussing last week, one of the things I was discussing on, over the weekend, on Monday, watch the explosive rallies. What we term the rip your face off rally. Again, this is really the definition of volatility. I think people miss the point of volatility. It doesn't necessarily mean just the infamous down move over here, but once again, the gap-filled wonderland of explosive up moves is one of the hallmarks of volatility. Now, the whole question that you're looking for, and they're looking to the answer, well, when do you get short this again? Are we heading back down over here? And that question right there is exactly why we get these explosive upward momentum moves. I mean, again, the SPX today up another 35 handles, and there was even more momentum after the cash closed today. The futures actually rallied even further than that. But again, that very question right there leads traders into trying to short these wild up moves. The more they short them, the more that our market is capable of running in their face. More people cover their shorts. Think about it. Shorting, what is it? It's selling. You get tons of people that sell into the down move. That's what professional trading firms do. They dynamically hedge with the markets. Give you a kind of a quick explanation of what the dynamics happen to look like. If you take a look at what most trading firms do, is they try to trade net neutral. They don't take huge directional positions. And as markets spiral downward, these firms are forced, in order to keep the directional risk mitigated, that is controlling the directional risk, these firms are forced to short into the down move. Okay? Eventually, great, somebody turns around and buys a couple. And what they do is they buy them back. And what do they end up doing? Having to dynamically unload those short positions. How do you unload a short position? By buying all the way back up. And then, consequently, you get a lot of retail clientele that are usually shorting down here, ducking out of their positions. We start to rally back to the upside. These firms come in and buy. And all of a sudden, we're off and running. Now, we get this position where, guess what? There's traders out there that are trying to short into this up move. And what are they doing? They are getting their guts squeezed out. That's what a short squeeze is made of. As the market starts to rally, they're forced to buy in because they're getting squeezed to the upside. We explode. That's really what volatility is about. It's about this dynamic hedging. Okay? Now, again, that question is, well, when's it going to end? The timing in volatility is kind of inconsequential. You're never going to be able to time volatile markets.นobody can. Nobody ever has been able to time it. There's no all-seeing, all-knowing Fibonacci. Now, I'm not going to spend a bunch of time ripping apart, technicals. Okay, one thing I've learned over the years, you draw enough lines in this chart, I bet you the stock will hit one of them. Think about that for a second. Let me draw a couple of lines in the chart over here and make sure the stock will hit one of them, especially when we're more volatile. Nevertheless, forget a timing component. When you're going to trade in the midst of moves like this, and I'm going to tell you right now, am I going to fade this move? What does that even mean? It means I'm going to sell into the up move, but you're not going to squeeze me out of it because I'm going to use a defined risk option strategy. Just the other day, we went out and we actually bought a put spread yesterday. Okay? In fact, added to the position a very small amount today because, again, I didn't fully allocate myself into yesterday's trade. So we're buying what's called an in-out spread. It's like an at-the-money vertical spread, a bearish put spread. For those of you that speak bearish language over here, buying a bearish put spread, and I'm going to sit tight. And you know what? We could have another explosive up day. Now, one thing I do want to point out, and for this, we're going to look at a chart. So, it hit the major headlines today. We've actually gotten back over half the losses of the British exit. I'm done with saying the Brexit. And by the way, the Brexit, it's a done deal. Listen, you had Germany today ultimately say, let's make this a quick and painless divorce. So that was the old up and get out. So the block of 28 is now down to 27. Give it a little time. It'll even get better over there. Nevertheless, you get back more than half of the losses from the British exit. Okay? However, there is one thing in play over here that I don't think a lot of traders are looking at. Some of the gains that you're getting back happen to be in energy. But is energy a large sector? Yes, energy is a large sector. So taking a look over here, energy has done spectacularly. Right? And it's actually gotten back more than even half the gain. So on a sector-by-sector basis, energy's done phenomenally. Now bear with me for a second. If you look at something like the XLF, the financials, all right, they're about halfway home. So they haven't necessarily come back nearly as much as maybe energy. But then there's something that really stuck out to me. And there's a few of what I call, and I can't use the cliche terms. If you call them FANG stocks, I'm out. I'm out of the contest. I can't stand some of the cliche terms. I prefer to call it the Titan of technology, which would be something like Google. Google's in a wild downtrend prior to the British exit over here. And I want you to note, it's absolutely come back, but it's still under a very key threshold level of 700. So recognize that major NASDAQ stocks were in a downtrend prior to and might be coming back. All right. However, still incredibly weak here, even in today's move. Note in today's move where you had Google only up 0.6% with the NASDAQ exploding once again to the upside. Now, take a look over at Apple. Again, this is what I call the Titans of technology. Apple's the exact same thing. In a pretty wild downtrend prior to, pops its head above water. Okay, getting even more interesting. Let's go to Amazon. Amazon's the odd man out over here. Amazon, once again, is approaching all-time highs. I'm going to look for a short opportunity in the coming days inside of Amazon. If there's any follow-through to the upside, we're going to use an in-out spread. Get directional, get bearish. Why? Nice setup. I mean, think about the comeback over here. We already made money to the downside once in Amazon. We've made money to the upside in Amazon. Why not get short again? Trading, it's the same thing as insanity. We do the same thing again and again and again. Only thing is, we actually get decent results in something like Amazon. But again, keep your eye on some of these titans of technology. Now, Facebook also in a fairly large downtrend. Now, granted, we do have earnings coming up. The other thing you have to think about with the remainder of this week, so here we are, it's a Wednesday afternoon. You got Thursday, Friday coming into a holiday weekend, all right? And one thing you got to question to yourself over here, sure, a couple of NASDAQ stocks are weak, but what is the market dictating about risk for Thursday and Friday? And what's kind of cool over here is a lot of people forgot with all the Brexit. Again, I want to put like parentheses, quotations around everything. The parentheses, by the way, mean you're losing. But anyway, it kills me because people forgot it's the end of the quarter. That some of the buy-side activity we could actually be seeing, okay, very well could be what they call window dressing over there. Stocks that are performing well, what do? Buy them! Explains a little bit about Facebook, explains a little bit about Amazon, explains why Google, okay, is sucking wind out there. It's the end of the quarter. When's the end of the quarter? Let's look at a calendar. Tomorrow. Okay? Coming into Friday, there still could be quite a bit of action. However, the market right now, what's it pricing in? Between today and tomorrow's close, about a $17 move in the S&Ps. That ain't half bad. It's a little less than today's, $35 expectation of price action. And again, the day after over here, a $23 move between today and Friday's close over there. So once again, volatility has come off over here. All right, if you're looking tonight for me to get I want to know definitively what I think. What I think? Fade the move. Fade the move means you got to get short into this wild up move, but you have to do it in such a way that you can sustain the position. Think to yourself, one of the phrases we use here at TheoTrade all the time, duration over direction. That basically means you need to sustain that position long enough to be effective. The only way to do that is with a defined risk trade. Don't go out there and start slinging naked options in the midst of the volatility. Because one thing I will tell you, you look at volatility, wow, it looks low. everything that we've been through, and you're going to tell me that the S&P volatility is back down to 16%? All right, markets again are incredibly efficient, and they're squashing, okay, all of the risk out of the marketplace. And forget again, we're past it. The British exit vote, it's done. All right, but earnings are coming up, and yet the market still squashes all the risk out and says, no, it's not going to be so bad. However, volatility still lies within the XLF. The financials still maintaining a substantially higher volatility. Think about it over the next couple of days. Again, look to execute trades in Amazon. If we continue very slightly higher in Amazon in the next day or two, I'm actually going to fade the move in Amazon, and I'll continue to set up to fade the move in the S&Ps. Also remember the phrase, duration over direction. If you can't sustain the risk, get out of the kitchen. You got to be able to hold your positions. You don't use stop orders in the midst of volatility. You can't, because you will get stopped out. Thanks everybody for joining us here at TheoTrade.